Welcome back to Alabama's Morning News. Good morning. My name is John Mounts. I'm filling in for JT today. And tomorrow, most economists expect the Fed to increase its second 0.75% increase of the short-term rate. And you go, what does that mean to the price of gas, and the price of my house, and the price of everything? Well, we're going to tell you with the commentator from Young Voices and Eric Peterson. What does this mean, Eric?
This means that the Federal Reserve is taking inflation incredibly seriously for the first time in quite some time, and will be doing all it can to really hit the brakes fairly hard on the economy and a chance to get inflation under control, which has been a big drag on economic growth in this country. Right, we had a low GDP the last time it was measured, and it looks that the messaging out of the White House is we were going to see economic shrinkage yet again. So as the Fed tries to get inflation under control, it looks like we're going to be struggling to see economic growth in the coming future.
And that's the double-edged sword, of course, because this is not the prime lending rate, but it does impact that, and it does impact what you would pay for a house loan. So once again, I remember it was just a year ago when we were talking about mortgages in the 3% range, and then the upper threes, and then the fours, and now the 5. So what do we think this is going to do to things like those rates?
Yeah, obviously, if you're looking to buy a house, it's going to be really tough to get a good rate right now, right? You're going to see rates in the 5 and 6%, coming very soon, depending on what your credit score is. But it's more than just expensive to borrow money for a house, right? It's expensive to borrow money to start a new business, to make an investment, to purchase assets on Wall Street. So, as the price of borrowing money goes up, you're going to see a slowing of economic movement. Now, of course, our job market looks really good. We still have more openings and we have people looking for jobs. So whether or not it's going to cause, an increase in unemployment is still yet to be seen. But in terms of economic growth and the amount of money flowing through the economy, it's likely to decrease that. But of course, that is what it's there to do, which is finally fight inflation, which has been running rampant for the better part of last year.
One of the things I found interesting was the Biden administration said they're going to do what they can to fight inflation and ease up on things by giving people money. And they keep giving people more money. And in doing this, isn't that actually causing the inflationary problem? Every time the government says, let's give everybody more money, we'll just print more money and give you more money. Isn't that just doing the very opposite of what the Fed's trying to fight?
Yeah, I mean, fiscal stimulus definitely has a huge impact in this as well. But, at the end of the day, the Fed sets the money supply, and they've been injecting trillions of dollars of liquidity into the market. I think that has a much larger impact than any sort of small stimulus that, California or Florida might be doing in terms of cutting taxes or putting any kind of that money back in the economy.
A while back, I collect in my spare time old money, mostly coins, but I've got a silver certificate from 1923, I think it is, and it says it's a $5 silver certificate. There was a time when all of our currency was backed by some sort of asset, right? It was backed by gold, backed by silver. That's no longer the case. Now we have a Federal Reserve note. So really, the government can pretty much say money's worth whatever they want and make it worth. So it seems like this is going to get worse before it gets better because our money really is it's indeterminate, right?
I wouldn't go that far. Right? The value of your money is dependent on how much of the money supply is out there. And we've been in a time of great fiscal expansion post, fiscal meltdown in 2008. And a lot of this, certainly could have been avoided had the Fed sort of eased up on putting liquidity or more money into the market past then. But the last time Powell tried to do so, the market had a massive 20% sell-off, and the central bank got really, really jumpy there. And I think now we're going to be in for a much harder economic landing because of that.
And I noticed the administration is also very hesitant to say that we're headed into a recession. They said 2 quarters. They keep trying to move the ball and redefine what is considered a recession. They say, well, 2 quarters of negative economic growth is a recession. But they say, well, that's the dictionary definition. But that's not really where we are right now. Are we going to admit at some point that we're looking at a recession, or is it one of those things where the moment you say that, you wish it to be so, even if it's not?
Yeah, I mean, I think you're going to see most economists say that we are going to be in a recession. Now, this recession is going to look very different from the last one. Like I said, the unemployment rate's at about 3.6% nationally. A lot of states are below that. And there's still a lot of slack in the labor market, which is a very odd thing for low economic growth or negative economic growth and really high inflation. The question is, will eventually inflation and the lack of economic growth show up in the labor market anyway? That remains to be seen.
Eric Peterson from Young Voices, thank you so much for joining us this morning on Alabama's Morning News.